Feeling like your investment options stop at stocks and bonds? Well, get ready, because we're about to unlock a whole new level. Alternative investment funds. AIFs for short.
Yeah.
Think of it as peeking behind the finance curtain, to see where some really interesting money is moving.
Exactly. And based on the info you've shared, our goal today is, well, to really dissect these AIFs. We'll look at their history here in India, the rules they follow.
Regulations, yeah.
The different types, different strategies, and crucially, how they might fit into, let's say, a more sophisticated investment approach.
Right. So our mission is to cut through the jargon, the complexity, and give you the essentials on AIFs, just the key insights you need without feeling overwhelmed. Okay, so the name says alternative. What does that actually mean when we talk about investments?
Simply put, alternative investments are financial assets that sit outside those traditional buckets, stocks, bonds, cash.
The usual suspects.
The usual suspects, exactly. Investopedia puts it clearly.
Yeah.
It's a financial asset that doesn't fall into one of the conventional categories. So, yeah, things that operate a bit differently.
And who usually gets into these? It sounds like it might not be for everyone.
You're right there. AIFs are generally geared towards more, sophisticated investors.
Okay.
Think large institutions managing big funds and high net worth individuals, HNIs.
Right.
These are investors who usually have a better capacity to understand and also absorb higher levels of risk. And they're often looking for opportunities beyond the public markets.
And higher risk.
Yeah.
That often means the potential for higher returns, yeah. Is that the main draw?
That's often a big part of it, yes. AIFs can offer the potential for returns you might not find elsewhere, but this is important. That potential comes with greater risk, always. And another key difference is liquidity.
Right, getting your money back out.
Exactly. Unlike stocks you can sell easily, AIFs are generally less liquid. Illiquid, even.
Meaning it's hard to convert them back to cash quickly.
Precisely. Either because the underlying assets themselves aren't easily sold, or the fund structure has rules about when you can exit.
Okay, so a different risk profile, different liquidity. Globally, who are the big players putting money into AIFs?
Internationally, it's mainly institutional investors. You've got pension funds needing long-term diversification.
Makes sense.
Various investment funds, insurance companies managing their reserves, university endowments, foundations.
Investment banks, family offices.
Yep, investment banks, family offices managing wealth for the super rich. And, of course, the AIF managers themselves often put their own money in. Significant capital flows into these alternatives.
Okay, that paints the global picture.
Yeah.
But what about here in India? How did the AIF scene get started?
Well, in India, the journey really began with venture capital back in the 1980s.
Oh, that early.
Yeah, mostly driven by state-level bodies, industrial development corporations, financial institutions, public sector banks that were trying to foster new industries. It was, a more nascent stage compared to global markets then.
And what gave it a boost?
A key moment was 1996. SEBI broadened the definition of venture capital. It wasn't just about untried technologies anymore.
Right.
They included private investment in unlisted companies as institutional investment. But the tax situation wasn't great initially.
Right. Taxes can make or break things.
Definitely. It was the tax reforms in 2000, based on the K.B. Chandrasekhar Committee recommendations, that really gave the sector a push, made it much more attractive tax-wise.
Ah, okay. And then came the late 90s, early 2000s, the dot-com boom. Did that play a role?
Oh, absolutely. That period, say 97 to 2001, saw a huge rise in tech-focused VCFs. Venture capital funds.
Inspired by Silicon Valley, I imagine.
Very much so. All the excitement around the internet, new tech. It drove a lot of investment into those early stage companies.
Makes sense. Tech was the hot thing. But after the bubble burst, what happened? Did private equity and VC just dry up in India?
Not at all, actually. Post-2001, private equity here really diversified. It moved beyond just IT.
Into other areas.
Yeah, manufacturing, real estate, infrastructure, various services. By around 2007, that early sector bias was largely gone. PE was even getting into banking, logistics, e-commerce, project financing. Quite resilient, really.
Wow, quite an expansion. But then, 2008, the global financial crisis, that must have hit hard.
Oh, it did. Big disruption, globally, and definitely in India, too.
How so?
Well, funds struggled to support their existing companies. And exiting investments, really tough with weak capital markets. The years after that were about navigating a trickier economy and some uncertainty around tax rules as well, a period of recalibration, you could say.
Okay, so that brings us more towards today. SEBI now has clear rules for AIFs. How do they actually define an AIF now?
Right. The SEBI AIF regulations from 2012 are key here. At its heart, an AIF is defined as a privately pooled investment vehicle.
Privately pooled, meaning not for the general public.
Exactly. Funds collected from a select group of sophisticated investors, institutions, HNIs, and there's a cap maximum 1,000 investors per scheme raised via private placement, not a public offering.
Okay. And are there specific conditions like minimum investments to get into an AIF?
Yes, several key ones. First, they can raise money from Indian investors, foreign ones, and NRIs.
Okay.
Second, each scheme needs a minimum size, a corpus, of 20 crore rupees.
20 crore. Wow.
And for an individual investor wanting in, the minimum ticket size is generally 1 crore rupees.
1 crore. So definitely not small change.
No. There is an exception, though. For employees or directors of the AIF or its manager, the minimum can be lower 25 lakh rupees.
Still significant, but lower.
Right. And SEBI also requires the manager or sponsor to invest their own money, skin in the game.
To align interests.
Precisely. For Category I and II AIFs, we'll get to categories, it's the lower of 2.5% of the fund or 5 crore rupees. For Category III, which can be higher risk, it's the lower of 5% or 10 crore.
And they have to tell investors about this.
Absolutely. Disclosure is mandatory. And remember, max 1,000 investors, private placement only, no public advertising.
You mentioned accredited investors earlier with a potentially lower threshold.
Yes, that's a concept SEBI introduced. It's not mandatory for all AIFs, but some cater to accredited investors. For them, the minimum investment can be 25 lakh rupees.
And who qualifies as accredited?
It involves meeting specific financial criteria. For individuals, it could be annual income over 2 crore or net worth over 7.5 crore with a good chunk in financial assets, or a mix of income and net worth. Similar rules for firms, trusts, companies. It signals financial sophistication.
Interesting. So a slightly easier entry point for some financially qualified folks. What about getting out? You said they're illiquid. Any way to trade them?
Well, for closed-ended funds, those with a fixed lifespan, SEBI does allow listing units on stock exchanges.
Oh, okay. So there's a secondary market.
In theory, yes. But, and it's a big but, the minimum trading lot size is 1 crore rupees.
1 crore.
Yep. And listing is only possible after the fund's final fundraising is done, the final close. So while possible, that high minimum lot keeps it inaccessible for many. You really need a long-term view.
Definitely sounds like a long-term commitment.
Yeah.
What about rules on where these funds can actually invest the money? Any restrictions there?
Yeah, there are several investment conditions. They can invest in companies outside India, but that's subject to RBI and SEBI guidelines.
Okay.
Also, if the manager or sponsor co-invests alongside the fund, their terms can't be better than the fund's terms. Fair treatment for investors.
Makes sense.
There are also limits on concentration. For Category 1 and 2, no more than 25% of the fund in a single company. For Category 3, it's tighter, only 10%.
Prevents putting all eggs in one basket.
Right. And investing in related companies, associates, needs approval from 75% of the investors. Plus, any money not yet invested has to be kept safe in liquid assets like liquid mutual funds, short-term instruments.
Okay, that gives a good sense of the rule book. Now let's get into the different flavors of AIFs. SEBI groups them into categories, you said.
Exactly. 3 main categories. I, 2, and 3. It's mostly based on their investment goals and strategies.
Okay, Category 1.
Category funds invest in areas seen as socially or economically beneficial or strategically important. Think startups, SMEs, infrastructure, social ventures.
So things like venture capital funds.
Yep, VCFs, SME funds, social venture funds, infrastructure funds, even special situation funds fall here. These often get some regulatory or tax incentives to encourage investment.
Kind of aligned with development goals then.
You could see it that way, yeah.
Oh.
Then there's Category 2.
Which is?
Basically, anything that isn't Category I or 3. A key thing about Category 2 is they generally can't use leverage or borrow money except for very short-term operational needs.
Okay, examples.
Your standard private equity funds usually sit here. Debt funds too, unless they get specific Category I incentives.
Got it. And that leaves Category 3. Sounds like maybe the more complex end.
That's generally right. Category 3 AIS can use diverse, often complex, trading strategies. And crucially, they are allowed to use leverage.
Leverage meaning borrowing to invest more.
Exactly, including through derivatives, both listed and unlisted. These funds often chase higher returns via active management, wider tools. Hedge funds are the classic example here.
Right.
Also funds seeking short-term gains or open-ended funds without specific Cat I incentives. But leverage means higher potential gains and losses. higher risk generally.
Higher risk, higher potential reward, more complex stuff. Okay. Now, within these categories, you mentioned specific types of AIFs. Let's break some down. Venture capital funds, VCFs, you said, were the starting point in India.
Yeah, VCFs under Category I focus on unlisted equity or equity-like investments in startups, early-stage ventures.
Companies with new products, new tech.
Exactly. New services, tech breakthroughs, IP, disruptive models. VC is often the first institutional money a promising company gets after maybe angel investors. Crucial for tech-heavy, asset-light businesses.
And you mentioned angel funds specifically.
Yes, angel funds are a subcategory within Category I DCS. They pool money from angel investors.
And who's an angel investor? Not just anyone with cash, right?
Right. For an individual, they need minimum net tangible assets of 2 crore, excluding their home, plus either experience in early-stage investing or being a serial entrepreneur or having senior management experience.
Specific criteria.
Yep. Or a company with a net worth of 10 crore or more, or another registered AIF VCF can also be an angel investor. It ensures some level of sophistication.
Okay. How do private equity funds, PEs, differ from VCFs then?
PEs, usually Category 2, also invest in equity or equity-linked stuff, but the difference is the stage. VCs are early stage, often unproven. PEs usually target more established businesses.
Companies with a track record.
Right. Proven business model, revenues, looking for capital to scale up, make acquisitions, restructure. They come in later than VCs typically.
Got it. VCs for startups, PEs for scale-ups. Now, debt funds and AIFs. Debt usually feels pretty traditional.
It can be, but debt funds in the AIF world, often Cat 2, invest in debt of listed or unlisted companies. The alternative part often comes from the debt itself being maybe privately placed bonds or debentures.
Less liquid, not publicly available.
Exactly. And you also see specialized debt strategies. Venture debt for VC-backed companies, leveraged loans for buyouts, distressed debt financing, insolvency resolution under the IBC, sometimes called private credit.
Much broader than just plain bonds. Infrastructure funds seem key for India.
Definitely. They're usually Category I, investing in unlisted securities, partnership interests, or debt of companies involved in infra projects operating, developing, holding them.
And who invests in those?
Given the illiquidity, long timelines, long payback periods, it's typically large institutions, sovereign wealth funds, specialized infra AIFs. You need patient capital.
Makes sense. Long projects need long money. What about SME funds?
Also Category I, they focus on investing in unlisted securities of small and medium enterprises, or SMEs listed on the SME exchanges.
Defined by size, I guess.
Yeah, based on the MSME Development Act investment in plant machinery turnover. The goal is providing growth capital to that vital segment.
Okay, and then the ones that get headlines, hedge funds. What's their deal?
Hedge funds are Category 3, known for diverse, often complex trading strategies. Try and get returns that aren't tied directly to market movements.
Using derivatives leverage.
Exactly. They can invest and trade in a wide range of things, listed and unlisted derivatives included, and use leverage. Caters to very sophisticated investors who get the complexity and volatility.
Definitely the advanced course. What about funds with a social mission?
Yes, social impact funds, typically Category 1. Their main goal is investing in social ventures or enterprises, trusts, societies, Section 8 companies, microfinance institutions.
Focused on social welfare.
Right. They need to meet social performance standards set by the fund, aiming for both financial return and measurable positive social impact.
Good to see that exists. Lastly, special situations funds. Sounds intriguing.
Also usually Category 1. They invest in special situation assets. Bit broad, but crucially, they can act as resolution applicants under the Insolvency and Bankruptcy Code.
Meaning they can step in to rescue troubled companies?
Essentially, yes. Propose and implement plans to revive distressed companies. Can offer returns and help economic recovery.
Wow. Okay, so AIFs cover a huge range beyond just stocks and bonds.
Yeah.
But how do they fit into the big picture? Managing a whole portfolio. Why use them?
That's the key question, isn't it? Traditional portfolio management is being challenged. People are looking for returns in a world that's, well, changing fast.
How so?
Think tech disruption, environmental issues, new regulations, economic ups and downs, geopolitics. It's harder to rely just on traditional assets, plus years of low interest rates in developed economies.
Pushed investors to look elsewhere.
Right, towards emerging markets and towards alternative assets for potentially better yields.
So it's just about chasing higher return.
It's more nuanced. A core reason is diversification.
Ah, not putting all your eggs in one basket.
Exactly. The idea is some alternative assets might move differently, have lower correlation to traditional markets.
So if stocks fall, maybe your AIF investment doesn't fall as much.
Or maybe it even goes up. By adding assets with low correlation, you aim to reduce the overall bumpiness, the volatility of your portfolio, and potentially improve your risk-adjusted returns long term. It's about spreading risk, accessing different opportunities not easily found in public markets.
Okay, so summing up, AIFs mean potential diversification,
Maybe how.
higher returns, but definitely higher risks, less liquidity. They're regulated by SEBI, need significant investment, target sophisticated investors, and cover a really wide range of types and strategies.
That's a great summary, yeah. So as you think about this huge landscape of AIFs, you might start considering, well, which specific areas or sectors within alternatives could actually align with your interests, your risk appetite, or maybe broader economic trends you see playing out. Could lead you to look deeper into, say, venture capital and new tech, or private equity in specific industries, maybe infrastructure, or even those complex hedge fund strategies.
That's a really interesting thought to leave us with. And it definitely makes you think hard about how that illiquidity and those high entry points compare to your regular investments. It's clearly a different world. Thanks so much for breaking down alternative investment funds for us.